Good morning, ladies and gentlemen, and welcome to this extraordinary market update webinar. Today, as usual, I'm joined by my esteemed colleague, Tom Becket, and we will hold a discussion, a conversation really, about how the events of the last 12 days, since the 28th of February and the onset of the air war over Iran, and the impacts this has had on markets and expectations for markets. The format will be Tom and I, as I say, will converse for about 20 to 25 minutes, and then there'll be time for questions and answers at the end. I'd like to stress as well that although this is an interruption in our normal routine of quarterly updates, there will be another market update webinar on the 22nd of April, and look forward to hopefully you joining us at that too. So Tom, welcome, first of all.
Well, thank you for having me, and we're delighted to give you an update on how we're thinking about the world. You said the term extraordinary. We might use that term a few times during today's brief update, and let's hope there's not another webinar between now and the one which is scheduled for me.
Let's hope not. Let's hope not. So Tom, thank you very much, and hopefully everyone can see the slides we put up on the screen. Let's start off by just reminding everyone where our base case for 2026 stood when we had the last of these webinars in early January, and how we set ourselves up then.
Yeah, and it's only a couple of months ago, and I think we need to stress from the very outset today that whilst we are seeing volatility in markets and we are seeing an interruption to the solid but unspectacular path that we were hoping for, and in a case of hoping for, not necessarily expecting through 2026, we do want to give very much the impression that whilst things are changing around us from a portfolio management perspective and our medium-term outlook for markets perspective, we're not here talking about radical change. But things have changed, as we'll talk about through today's quick update. So if we go back to January, it feels like a very long time ago, Richard, doesn't it already? Our base case for the year ahead was similar to what we had in place for last year. And it has to be said, over the last 3.5 years that you and I have been working together, the predictions that we've had around the global economy, inflation and interest rates have all been relatively precise. And we expected another year where it was going to be quite predictable, and we would see economic activity that was solid but unspectacular, that we'd see a continuation of the disinflationary themes that we'd seen through the last few years, after inflation was obviously a very big problem for everyone back in 2023 and 2024. And assuming that A plus B of economic growth plus disinflation took place, that we would see a couple of interest rate cuts this year on both sides of the Atlantic. Much more important for markets, what happens in the US. Obviously very important for lots of us on today's call, what happens in the UK, but a couple of interest rate cuts. And assuming that those were the building blocks for our asset allocation framework, we were quite happy to predict that we would see positive returns from both equities and fixed interest markets. So obviously, we have to recognise that in the last 12 days and the last 2.5 months, things have changed. But ultimately, we do stand by a lot of that base case we outlined only a couple of months ago.
Thanks, Tom. Well, we've had several thousand tons of bombs dropped on Iran, and a dozen countries attacked in Iranian retaliation, either by drones or by ballistic missiles. What has changed, if anything, to the outlook? You alluded to there being some changes. Could you just go into those in a little bit more detail?
Yeah, well, let's be completely honest from the outset. The one thing which hasn't changed is that we are still very much operating in the backdrop that we have referred to as the Turbulent Twenties now for getting on for 7 years. Whether it was the COVID pandemic or it was the issues that we've seen in the Middle East around Venezuela, over the Russia-Ukraine war, over all the various different political situations that we've seen around the world, all the economic uncertainty, all the inflation uncertainty. Let's be honest, Richard, but we've been operating in this environment for the last 7 years, and I'm fully expecting that we're not going to get off lightly, and it's going to carry on being like this until the end of this turbulent decade. But ultimately, so nothing has changed from the structural backdrop, which has been, for for lots of uncertainty, but positive portfolio returns just with more volatility. So to be completely frank from the outset, this isn't necessarily out of that framework that we've set and is nothing out of the ordinary from what we've seen this decade. However, in the very short term, things have obviously changed because the Middle Eastern tensions have ratcheted up significantly, and there's frankly very little predictability as to what might happen there next. So, our job is not to try and be geopolitical experts. It's not really to try and take on the role of military strategy. We can try and guess at some of these things, but like everyone on today's call, we are guessing at a lot of these things. But what we do need to think about is what the impact might be on the economy, what it might be on inflation, what that might mean to interest rates, and ultimately, as we're going to talk about later, what it might mean for returns of the two main asset classes in portfolios, equities and fixed interest. So let's deal with each one of those just very quickly. So in terms of the economy, this adds to the sort of, potential for fat tail outcomes, i.e. potentially much slower rates of growth. And if it gets resolved quite quickly and we start seeing rebuilding, various things like that, potentially faster rates of growth than we are predicting. So I think on balance, we have to stress that this is not good for economic growth, but we also do need to remember that the first derivative impact of a problem in the Middle East is not necessarily a big factor for global economic activity because the Middle East is relatively small as part of the overall economic pie. The second derivative is obviously more important. If we see energy prices and oil prices at elevated levels for a long time, that will impact corporate confidence and therefore capital expenditure from companies. It will impact consumer confidence and therefore consumer spending from all of us as consumers who might put off purchases to another day. Now, there is a risk of this, not least if oil prices stay high, Richard. That means that we're in a situation where we're paying more on energy and more on bills and less on consumer products, which means that the economy would slow and inflation could remain higher for some time. And I think the chances of that have undoubtedly risen, which therefore would lead to questions about whether or not the central banks of both the UK and the US can cut interest rates as we were expecting. Ultimately, if economic activity is still questionable, but inflation has risen, that does tie the hands of central banks a bit. So I think of the sort of final piece of the jigsaw, we would have to suggest that if the problems carry on in the Middle East, our forecasts for positive returns of equities and bonds probably still hold true, but we'd have less conviction in that than we might have done previously. But we have to be very honest about this and say that we don't know what's going to happen next in the Middle East. If this is resolved quite quickly, I suspect that we get back on track really quite quickly. If it goes on for a very long time, which as we're going to talk about would be a big problem for President Trump and a big problem for the Republican Party heading into the midterm elections, then clearly we will need to once again adjust our expectations for the year ahead. But to be clear, if this gets resolved quickly, then I think we get back to normal really quite quickly.
Thanks, Tom. And of course, that flexible mindset is something that we embed very strongly in our process. At the beginning of the year, we talked about valuations being full but probably fair. Do we still think that's the case?
Yes, I would say that valuations are still full but fair, but we have seen a lot of significant changes this year. And whilst today, obviously, we're focusing in on the geopolitics, we can also touch on things like the AI apocalypse that we heard talked about earlier this year. The market's mindset has shifted onto what we're seeing in Iran, for the short term at least. And we can also talk about some of the ructions that we're seeing in private credit markets and the impact that's had on credit markets. And both of those situations have brought down valuations, which is good. But at the same time, it has increased uncertainty, which is obviously less good. So I think that we're still quite comfortable talking about full but fair. But ultimately, if we're in a situation where economic activity is impacted, and therefore we go through a period of slower corporate profits growth, which is what the markets have been telling us for the last couple of weeks, then that could be an impact upon future market returns. And obviously, if earnings come down, as you'll talk about later, therefore valuations look higher because companies aren't delivering the earnings that they were previously expecting. But I think the very basic message is that there's sort of an equation that you and I talk about, Richard, isn't there? There's an economic impact and a valuation a judgment that you make about deciding how longer term asset class returns might be. We've already said that the economic outlook is less certain, but that being said, it's been very uncertain now for a very long time. When it comes to the valuation element, we can have a little bit more certainty, and we would suggest that after seeing a pullback in certain investments so far this year, and a fall in certain equity valuations and a rise in yields in fixed interest markets, as we'll talk about in a minute, that means the valuation argument has actually got a little bit more compelling. Now, ultimately, again, we don't know when this sort of short-term market correction might end. We can try and give a best guess to that. But ultimately, losing some of the complacency that was in place in markets at the end of last year, is probably a good thing from a medium-term perspective. So full but fair is still appropriate. But the other piece of good news is the market volatility does breed opportunity. And at the moment, we're starting to see some more attractive investments for us to take advantage of on behalf of our clients.
Thanks, Tom. Let's go into that in a little bit more detail. We often joke, you and I, that you deal in bonds which are a bit boring but are based in reality, whereas I deal in equities which are more exciting but less based on reality. In bonds, in your specialist area, if I could put it that way, have the movements of the last fortnight or so thrown up any opportunities that we can exploit?
The answer is unequivocally yes. Opportunities are starting to be presented, and it's our job to take advantage of those on behalf of our clients. And we'll get into some of those specifics in a minute. Just as a sort of guide to how Richard and my life is working these days, I wrote this presentation getting on for a week ago, and originally it said fixed interest, 2025 a good year, 2026 has started calmly. Obviously, that's now changed. So thank you to our compliance and marketing departments for updating this. It has obviously become a lot more volatile, as you can see from the sort of right-hand side of the chart and the declines we've seen recently. Now, what's been interesting, if you go back to the basic building blocks I was talking about earlier, people have become more concerned about the economic outlook. They also become more concerned about inflation, and therefore interest rate expectations have come down. The expectation is for fewer cuts and maybe interest rates holding at current levels through the rest of this year. So bond markets have been a bit under pressure, nowhere more than the UK government bond market or gilt market, where we've seen some quite substantial moves which are throwing up opportunities on behalf of our clients, both at the short end, where we've talked about tax efficient opportunities, but also throughout all of the sort of bond maturity curve, where we can take advantage of high yields and lower prices. So yes, what we've been seeing, Richard, is the concerns over the Middle East and the impact on the economy, the impact on inflation, and the likelihood for lower and a smaller number of interest rate cuts is throwing up good opportunities in bond markets. And really, the reason we think it's a good opportunity is we do recognise that there are short-term distortions and there are short-term uncertainties. But ultimately, it's up to you and I to try and look through those situations and really think about the medium term for markets and where we can make good opportunities for clients out of the chaos that we're seeing, whilst also trying to mitigate the risks of this getting more out of hand. And ultimately, we are able to do that more efficiently now than we could a couple of weeks ago. Fixed interest markets and bond yields are still attractive and good opportunities for clients. And in the last couple of weeks, they've got more attractive because yields have gone up. And ultimately, if we think that if the situation in the Middle East eventually calms down and we get back to that solid but unspectacular growth path, and we get back to that sort of situation with disinflation rather than the fears of inflation, and we see a couple of interest rate cuts as we're expecting in both the UK and the US, that will lead to bond markets not only stabilising and finding their feet, but also starting to perform positively once again. So to put that into context of the inflation path we're going to expect ahead and what we might see from interest rates, on this chart here, you can see the journey that we've been on in inflation for the last sort of 15 years or so. Inflation was calm and predictable through the last decade. It rose materially through the aftermath of the COVID pandemic, and then it started to calm down. And this year, we were expecting a period of it calming down. The white line is the UK inflation rate, perhaps most relevant for most people on the call. The red line is the US inflation rate, more relevant for global markets. I think what we should expect here, Richard, is perhaps an uptick in the next few months as the inflationary pass-through of higher energy costs from the situation in the Middle East takes effect. But thereafterwards, we should start to see things get back to the trends that we were seeing beforehand. And that gives us confidence that fixed interest investments do offer good value and better value than they were only 2 weeks ago. And on the right hand side of this chart, you can just see that broadly the expectations were for two interest rate cuts in the US and indeed two for the UK. The market has started to factor out that expectation and expecting fewer interest rate cuts. But we believe that once we get through this painful period and a period of readjustment and uncertainty, we'll get back to talking about interest rate cuts once again, which will mean taking advantage of fixed interest opportunities now is appropriate. And ultimately, they start to really contribute towards a recovery in portfolios in the second half of this year.
Thanks, Tom.
So let's get on to now think about equity markets. And you and I have obviously been doing a lot of presentations recently. And I think the one thing we'd like to make out for clients very clearly is that the volatility that you can see embedded in this chart in the more recent period does come after a really strong period, really Richard, ever since the sort of second half of 2022, and in particular, turbocharged over the last 12 months or so.
Yeah, so let's make sure we keep that perspective because equities obviously had a very soggy period during 22 itself. But since then, as you say, have recovered very nicely, led initially by the US, but really encouragingly in the last 15 to 18 months, broadening out so that many more areas are now contributing, as we can see from this chart, to growth in equity returns. So whereas in 23 and 24, this chart would have shown the US, the purple line, at the top by far. Now you can see emerging markets, Europe excluding the UK, and indeed the good old UK itself, driving ahead really quite nicely and helping returns broaden out, which is very healthy. So let's not lose sight of that. We've been through periods of significant turmoil during this period, including, let's not forget, the tariff turmoil that was so prevalent at the beginning of 2025. And you can see that spike downwards in the early part of this chart. But overall, we've ground out some really quite good returns. Now, whether or not we're going to see a similar kind of quantum of return, assuming that we get back to normal fairly soon, is perhaps moot. We'll come on to that in a bit. But I think in general, the environment does not look too horrible for equities unless this war embeds and becomes something that grinds on for months and months and into the years, which we don't expect at this stage.
No, that's absolutely that's not the case. I mean, ultimately, we should expect sort of higher geopolitical risk factor, but we've dealt this for quite a long time now, haven't we? So ultimately, whilst there is a chance around that, our base case would still be that we get through this and we start focusing back in, hopefully, on economic fundamentals. But one of the things which is interesting from this chart is you rightly point out that some of those markets like the UK, Europe, and the emerging markets performed really well last year and started this year in fine fettle. They've corrected quite a lot recently, but interestingly, despite the fact there's been a great deal of concerns about the technology sector and the US equity market, that's been really quite protective through the last few weeks, hasn't it? So why has that been the case?
Well, a few reasons, and it's a good observation. I mean, the first of which is that when you get these geopolitical storms, people or short-term investors tend to fly to what they view as safe havens. And the US, the largest equity market in the world, backed by the US dollar, the world's reserve currency, is traditionally seen as a safe haven. And indeed, you can see that dotted line at the bottom of this chart is the dollar index. And that has actually begun to recover sort of this year and has held up quite nicely, performing its function as a safe haven. So safe haven status, that's helped it. The second is that you're quite right. Some of the technology names have had a bit of a struggle actually in the last part of last year. But because of that, some of the froth has come out of them. And that has meant that although they've gone more or less sideways, when the rest of the world is struggling more in the face of geopolitics, they've held up better. And the final point to make about the US is that about 15 years ago, the US was a massive oil importer, and now it is actually an energy, in other words, oil and gas exporter, largely down to the spread of fracking throughout the southern part of the United States, which has absolutely transformed the energy dynamics of the US market. So it is less impacted by an oil price which has gone from something like 60 to 100 this morning, or 85 yesterday. You can tell there's enormous volatility because it is now an energy exporter. So, to a certain extent, the US is more insulated than the rest of the world from the disruptions we're seeing in the supply of oil and other similar commodities through the Straits of Hormuz. And finally, one thing, and actually this applies to all markets, over the last 40 years or so, the energy intensity of all the major economies of the world has declined sharply. So, whereas in the 70s, the oil shocks we saw then had an enormous impact, short term, medium term, and even long term impact on economies because energy intensity was much higher. Today, the impact of oil price shocks is less on economies, but particularly the US economy because of their export status in terms of oil.
And you touched on the technology sector there as being one of the sort of preeminent drivers of the outperformance of the US market in the last couple of weeks. But what's been really interesting in the last 15 months or so, not least because, let's be honest, we'd all become used to a period where technology sector was frankly the only game in town, leading to that sort of period of sort of US extreme outperformance. But actually, if you look back over the last 15 months, Richard, there's been a lot of sector rotation. And when we combine that with the sort of headline volatility we're seeing in markets and sort of stick to our mantra of volatility is the friend of an investor, not the enemy, this is throwing up lots of opportunities, isn't it? So have we adjusted our sectoral sort of preferences, or are we still doing much of the same?
The short answer is we're doing much of the same for the time being. The sector mix that we've seen and the broadening out that we've seen in sectors, so it's not just geographies, it's also sectors, as I said earlier, is a healthy phenomenon. And we felt very much last year as that broadening out started to occur, it talked to our base case for economies doing a little bit better than people were expecting. So more economic growth means cyclicals and things like financials can continue to do pretty well. As interest rates come down, things like utilities, which tend to react in line with interest rates, they can do well. And technology, which had led for so long, takes a breather. Now, I just want to highlight that at the beginning of 25, we would have said that technology was feeling a little bit uncomfortably expensive. Today, technology is actually cheaper than it was at the end of 24, early 25. And that's a result of extremely good earnings. There have been exceptional earnings, particularly in the last three quarters, from the major technology names, but more widely in the market as a whole. And that's helped the valuation story catch up with the actual state of play on the ground. So that whereas things were perhaps a little bit expensive, they're still probably a little bit expensive, but they are not quite so concerning as they were, say, a year ago. So there is broadening out, but longer term, we remain committed to some of the themes that we play and continue to play in terms of healthcare, in terms of infrastructure, which today also involves feeding the AI boom through electric power, for example. And even in our core bias towards what we call quality at a reasonable price, where we think that this will give us access to some great companies which have derated. Consumer staples is a great example of that, where the relative valuation is now pretty attractive. So net at the moment, we haven't got sucked into wanting to go heavily into energy stocks, for example, because our base case remains that the conflict will resolve fairly quickly, and that the world will get back to normality fairly quickly as well.
Yeah, I hope so. There's a Becket family holiday travelling through Dubai in less than a month's time, mate. I need to reschedule that, Richard, but I'll update everyone on that on the next webinar we have in April. So it sounds like from where we sit here today, we used terms back in January such as cautiously optimistic about the outlook for equity markets and sort of confidently opportunistic. And I should point out to everyone on the call, it was only a year ago when we were going through the Trump tariff turmoil when Richard came on one of these webinars and very much stood by his views from the start of that year, that was that equity markets make a positive return, despite the fact that things look very negative when we did the webinar back in last April. So I guess the question again here, Richard, is are you happy to stand by those views you had at the start of the year? And a sort of second question of how do you translate today's valuation mix, as shown here in front of our clients today, into future expected equity returns?
A great question. And look, the short answer is yes, I can stand by what we are positioning at the beginning of the year, but we've got to acknowledge, obviously, that risks have increased.
Mm.
So if I were to put a number on the kind of expected return from the beginning of the year we might have had for equities, we'd have said something high single digits, or 8, 9, maybe even very low double digit once income is incorporated. Um, but today we're probably, because of the risks that have increased, a little less optimistic. So mid to high single digits, so 7, 8% rather than 9, 10%. So not an enormous difference, but one that we've got to be aware of. And the point you make about valuations remains a very good one. On the table on the right-hand side of this chart, you can see that compared with the median 20-year valuation of equities, equities do look rather extended. All those are positive. So the current valuation is higher than the median, the average valuation, by some way in some cases. Bear in mind that 20 years, of course, includes the global financial crisis at the beginning of it, where valuations were dropped much lower, and the early parts of the last decade, where again valuations were much lower. But nonetheless, we've got to bear that in mind. We still think there are pockets of good valuation, and you can see where we stand relative to the 2021 high, when interest rates were very low, of course, and valuations themselves were much, much higher than they are now. So we're in between sort of that place of things are a little bit expensive, but we've got some way to go before they get alarmingly expensive. And that's particularly the case because, as I mentioned earlier, corporate earnings are coming through very strongly. We expect economic growth to continue, and we still expect some interest rate cuts, all of which sustain those relatively high valuations. We are very cognizant that there is a strong correlation over the long term between the starting valuation of equities and the return you achieve. So when you buy equities at a starting valuation that's very high, you can expect slightly lower longer term returns. And we are absolutely acknowledge that the very long run return on global equities is about 9%, slightly more in the US, slightly less outside the US, 9% per annum, that is. So from where we stand today, we would be expecting a slightly lower amount of return per annum from equities.
Which again has pretty much been our base case through the last few years and has proven to be relatively precise. So let's hope that's the case going forwards. And of course, we remain open-minded and ready to be flexible with our approach if needs be. But for the moment, it very much is a case of steady as she goes, but at the same time using the volatility to our advantage. So if you think about the overall makeup of our client portfolios, and I'm talking sort of general terms here, but we would argue to be sort of neutralish in equities, so in line with your long-term strategic asset allocation, and likewise in fixed interest markets as well. We believe the valuations of both major asset classes are appropriate and sensible for the outlook that we currently have. Again, with some wiggle room around that if necessary. If that sounds like Rich and I aren't working hard enough, and the rest of the teams implementing portfolios are perhaps not being sort of as flexible enough as they need to be, just take into account that beneath the sort of bonnet of asset allocation, we also have lots of different levers to pull with regards to different instruments. At the moment, it's very much a case of leaning out of those things which have done well or held up and leaning into those things which might have been treated unfairly in the recent market volatility that we've seen. From a headline perspective, in fixed interest markets, certainly more attracted to the opportunity set in UK gilts, which has been brought around by higher yields, and perhaps taking some profits from some of those things which have done well recently, things like commodities and things linked to energy. So very much steady as she goes. Asset allocation is still neutral, but really trying to fine-tune portfolios to maximize the opportunity set whilst mitigating the obvious risks that are out there. So I think as Richard prepares for the questions and answer section, just in terms of concluding and summing up where we are, we described last year as the quintessential turbulent 20 year. Look, 2.5 months into 2026, it's already rivaling it. The key risks ahead for us, undoubtedly, what's happening in the Middle East, where we have to be open-minded, and what impact that might have on both the economic backdrop and the outlook for inflation. At the moment, we're not radically changing our views. We are obviously moving the dial a little bit, but current market conditions probably still imply that this year will be a year of moderate economic activity, moderating inflation, and a moderate number of interest rate cuts. And typically, when you see a situation like that, that is quite supportive for asset market returns, albeit with lots of volatility. But ultimately, we believe that will be the case this year. But at the moment, portfolio is very much a case of balancing risky investments alongside safer investments and trying to prepare a portfolio for all weathers of 2026 and whatever might get thrown at us. So speaking of being thrown at us, Richard, let's get into the questions. Thank you.
Thanks, Tom. We've got some real humdingers as well, so thank you for the questions.
I think we had enough humdingers already this year, Richard, but let's get into some of the questions.
I'm going to start with you, Tom. I think there's one for you. You mentioned commodities and oil and just a moment ago.
Yeah.
There's a question about our views on both precious metals and indeed broader commodities. Do you want to pick that one up?
Yeah, absolutely. And I'm prone to contradict myself, and I did that on the last webinar when we presented to our clients back in January, because I said that I would always want to hold some gold in some form in portfolios, but at the same time, I wouldn't have been buying gold back then on the basis that we believed that gold had run into an era of speculation. Where people were treating gold as less a safe haven store and more an obvious attraction of speculation and momentum, which having performed extremely well, people were getting very involved in the market, in the gold market, and assuming that things would carry on going up at an incredible pace. So we believe that gold had lost, pardon the pun, the shine of safe haven protection in the short term and become more of an instrument of speculation. I think that's been the case through the last few months. What's been interesting is that the gold price has not made a new high through this most recent geopolitical incident, which is somewhat contrary to most people's belief that it probably should have done. The fact that it didn't probably tells us it is in the realms of speculation at the moment. And whilst we would still hold some from a long-term perspective of believing that gold still offers good protective values in the long term, in the short term, that's more questionable. I also talked about being more positive broadly on commodities, industrial metals, energy, and all forms of the commodity complex. That's been a good view so far this year. Commodities have performed strongly. And this week, with the extreme volatility we've seen to the upside, with particular concerns about the prospects of a medium-term closure of the Straits of Hormuz, that's led us the opportunity to take a few profits in energy-related commodities. And ultimately, whilst we would still own some commodities and some gold, I think we need to recognise that this is throwing up the opportunity to fine-tune portfolios further. Now, a link to that, one of the questions which I can see is come from me. We regularly get questions on cryptocurrency, and I always throw them back at you, Richard. So apologies for this. But interestingly, talking about the sort of store of value and the protective element of safe havens, gold and cryptocurrency were very much chucked into the same sentence previously. But actually, whilst everything that's been going on this year, we've seen a material pullback in cryptocurrencies. So what's that down to?
So there has indeed been a massive fall. I mean, not that long ago, end of 2025, Bitcoin was at $125,000, and this morning it's at $69,000. And a bit earlier it was at 63. So effectively it has halved. A few things to say about that. I mean, Bitcoin and crypto generally is an extraordinarily volatile asset class. And we've had these kind of drawdowns before. This is, I think, the fourth in the last 8 years for Bitcoin of this kind of nature. So it is a very hot money, risk on kind of investment. And there was a general feel that it had gone too far too fast at the end of last year. And then quite suddenly, as weight of money shifts, as momentum shifts, people who were long start going short, and all these moves get very, very heavily exacerbated. If you are going to be playing in the crypto space, you've got to have a very high tolerance for risk and a strong stomach to cope with these kind of movements. The longer term trajectory has been spectacular from sort of its inception in the middle part of the first decade of this century. I mean, 100 times higher return than gold, for example, over that period, and gold has been no slouch, but it's been highly volatile, and obviously this reflects that as well. If you're looking for a longer term store of value against the risk that governments effectively default on their debt through inflation or debase their currencies, then there's still perhaps a case for crypto and Bitcoin. And of course, at least you're not buying it at 125, you're buying it at close to 70,000. But it is a highly volatile investment, very much stress that you've got to have a strong stomach, and it's not by any means for everybody.
So we've probably got time for one more question each. And given that you took that one for me, I'll let you choose between comments on US politics or the AI apocalypse. Which one do you want?
I'll take AI apocalypse if I could, Tom. The oldest person in the room, possibly, but I deal with all the new stuff. A number of questions around AI, both in terms of the opportunities, but also the threats. There is a group of technology seers who are sort of collectively known as doomers, who see that AI will effectively end the world of work for large numbers of people, and in particular for young people. And it's definitely true. It is very difficult for graduates to get a foot on the employment ladder at the moment. I think I take a more nuanced view than that in the longer term. If you think about the disruption we had at the beginning of the 19th century with the spinning jenny and the loom weavers and the Luddite movement as people smashed up the machines that were taking their jobs, ultimately there was dislocation, but new jobs were created. Many more new jobs were created, just in different areas. And I think AI will end up being very much more like that. So I'm an optimist rather than doomer in the medium term. But in the short term, we can see all sorts of disruption. So earlier this year, and it's slightly gone off the headlines for obvious reasons, there was a big period of volatility for some of the previously seen as strongest names with huge embedded data sets, like the kind of companies like stock exchanges, like the London Stock Exchange, for example. In the UK, we had a couple more of these. There's Experian, which is the credit rating agency, and RELX, which is a sort of a medical, scientific, and risk publishing group, all of which have got enormously deep data sets. And then quite suddenly there was a release of an anthropic agent, effectively, which seemed to imply that those data sets would be valueless. I don't think that's the case, because there's no way that Anthropic or all the other large language model owners can replicate those data sets. Those data sets are proprietary to those companies. So actually, that kind of volatility produces what I think are likely to be some opportunities in those companies. But at the moment, the fear factor is much stronger than the greed factor. Warren Buffett would say that's a good time to look at these kind of things. So AI, yes, societally throws up many challenges, particularly for the young, but I think we will end up in a better place because of it. And it's interesting to see that in the US, where adoption is probably more advanced than elsewhere in the developed world, productivity numbers recently have shown a decent improvement. And higher productivity means you can afford to run the economy hotter without generating inflation and pay people more for doing more work. Both of those things are economic positives that I'd support.
But I guess it's also going to take a recalibration of the economy, which could be painful in the short term, even
Yeah.
if fruitful in the medium to long term. And that leads into an interesting discussion about what we're seeing in both the US and UK politics, which have dominated lots of the questions which have come in this morning. So a quick update on both. In terms of the UK political situation, it's quite obviously very difficult. Um, we would go as far as saying that the current Prime Minister appears to be in office, but not in power. I think there is a concern about a shift further to the left, either to appease some of the MPs within the Labour Party on the backbenches. And we did, going back to the election of 2024, talk about having a very, very big majority as being a problem, not a benefit, because ultimately, when you've only got 100 core jobs in government and 400 MPs, it's quite difficult to satisfy everybody. And I think Keir Starmer is, sadly for himself, in a difficult situation now, as this is proving to be very much the case. So I think in response to the extraordinary success of the Green Party, both in the Gorton and Denton by-election, but also as seen in the more recent political polls, I think the Labour Party will shift towards the left, and that will be fueled by elements of the backbenchers. We've also got to recognise that whilst Rachel Reeves might have hinted that she was done this time after the last tax stealth increase in the budget of November 2025, the recent impact of what we're seeing in the Middle East wipes out that headroom that she's built up really quite quickly. And whilst there was an obvious benefit to higher tax takes as seen through the end of the most recent tax year, I think a lot of that was people selling investments and taking CGT ahead of any potential changes in the future, which in itself is a short-term gain but a long-term loss for the UK economy. I think we have to recognise that Rachel Reeves remains in a very, very difficult place in charge of number 11 Downing Street. And the outlook for UK politics has got more problematic, not less so, in the last few months. Again, that is reflected in the pricing of UK government bonds. And I think from a sensible medium-term prognosis, those investments now look more attractive than they did. The UK the US is frankly even more interesting for lots of different reasons, not least because the 2-year US presidential political cycle is obviously rolling on. As soon as you finish the presidential election cycle, you go into the midterm cycle. We're coming towards the sort of crunch point for that. Typically in the US, the midterms throw up bloody noses for those the presidents and the current party in power. We don't expect this to be any different this year, particularly if this unpopular war in the Middle East continues and any of the improvement in the US economic situation from the tax support, tax giveaways, and tax refunds that we're seeing to US consumers ends up being spent at the gasoline pump. That will not be a good backdrop for the Republican Party as they head into the midterms. So our base case is using a sort of sensible scenario analysis and historical analyses as well, is that the current situation where the Republicans have control of the White House, the Congress, and the House of Representatives, and the Supreme Court, the latter being less important, obviously, from a midterm election perspective, is that Republicans will maintain the presidency. Obviously, they will probably likely just cling on to the Senate, but they're likely to lose the House of Representatives to the Democrats. In fact, I think that's almost a given based on the seats which are up for re-election this year. That's going to make the situation in the US even more toxic than it is now. I would expect there to be an almost weekly impeachment attempt by the Democrats in the House of Representatives on President Trump. I don't think he's going to take that particularly well. All that matters less because after the midterms, the US president, typically in their second term, becomes a lame duck. Mr. Trump will not like that term, and it will start to focus on who's going to lead the Republicans into the next election, whether it be J.D. Vance or it's going to be Marco Rubio. I suspect if there's a more satisfactory outcome in the Iran war, it'll probably be Rubio. If not, I think it will be Vance. And of course, the Democrats will then try and put together a cogent argument as to why they should take control at the next presidential election, a lot of which will be based around who they're going to put forward as their candidate. So I think the US political situation is obviously very interesting. It's quite fluid, but I would expect the midterm elections to throw up lots of market volatility and probably an election result that Mr. Trump and the Republicans will not like. And that will lead to further economic and political volatility through the next few years. And really, Richard, to sum up, a continuation of that turbulent 20s backdrop we've been talking about for 7 years and will undoubtedly be talking about for the next three.
Thanks, Tom. Ladies and gentlemen, that's all we have time for. Thank you so much for taking the time out of your busy days to listen to us. I hope this was of interest and of use. We will, of course, be back, as I said, on the 22nd of April for another update, assuming, as Tom has already said, that we don't have something else extraordinary in the meantime. So it just remains for me to say thank you again. I wish you all the very best, and I look forward to seeing you again in just over a month's time. Thank you.
Thank you very much indeed.